Welcome back to F.A.C.E, I believe, Dario. How are you?
Oh yeah, I'm good, thanks. I've just come
Mr.
back from holiday
Perkins?
myself, so trying to
Yeah,
adjust.
okay. Yeah, well, it's nice to have you. That's for sure. And how long has it been since you and I had a conversation?
I think it was probably 3 months ago.
Oh, okay.
So
All right.
we were just kind of starting out at a kind of European hiking cycle. So
All right.
yeah, it
All
was
right.
about 3 months ago. The
All right.
ECB was getting people prepared for its first hike, and the Bank of England was kind of panicking a bit, and we had a
Yeah.
lot of pressure coming from the strong dollar.
Okay. So why don't we start there? So technically, the euro got turned back from, prior lows. The 20-year low was here around 103.40 as well, and we got rejected, couldn't close above it. In your view, do you think that the euro could dig in, put in a higher low, and then come off and then rally again?
Yeah, I think that we've kind of stabilized a bit here. I think the big change is obviously to the dollar. I would say that investors. I mean, I talked to a lot of institutional investors. They've been very focused on U.S. recession risk over the last 2 or 3 months. Since we last talked. And this idea that we're close to peak inflation. I mean, that's obviously been the big theme of the last
Right.
few weeks. And the idea that the pressure on the Fed to continue hiking at this kind of insane pace that we've been at in the first half of the year is beginning to diminish a little bit now. So that's giving us a kind of depreciation in the dollar, and it's helping all of these other central banks. And one of the things that I spoke about last time with you is that a lot of the pressure that those other central banks have been facing on the inflation side has been largely imported. We're not by any means having a sort of boom in Europe. It's been very different. We've been having a kind of stagflationary shock that's been coming from Ukraine, but there's been no boom here, and so all of the inflation has been imported. And those other central banks were just kind of following the Fed higher, because if they didn't, they were just importing more and more inflation.
Dario, do you remember where the G20 met and there was no fanfare over it, I think a month or so ago, right near the euro bottom uh, in July? So and the euro never moved lower. There's some conjecture by guys like Luke Groman that the G20 cut some kind of deal that they're being quiet about to, you know, uh, attempt to reverse dollar strength and support euro, support yen. Do you think there was any grand bargain struck by the central banks? Have you noticed anything that would tell you that?
No, I mean, I don't really buy that. I mean,
Okay,
I spent about half of my career in policy making.
okay,
They just
that
don't. There
that's
isn't
right,
that. You just don't get that. I mean, I used to work at the UK Treasury,
right.
did some work for the Bank of England.
You're a Gordon Brown's guy.
Yeah,
You said,
exactly.
Dario, what
You
should we
just don't
do?
get those. You don't get those levels of agreement internationally. It's just almost impossible. And I remember, very simple communiques that the G7 and the G20 wanted to put out in the early 2000s, and they just required endless redrafting and kind of nitpicking over particular words. The idea that these guys could get together and agree some kind of grand bargain for exchange rates, I just think is a bit fanciful at this
All
point.
right, so the days of a plaza accord is no longer possible because we don't have the same type of central bank cooperation.
Exactly. We're just a long way from that. Those kind of
Allies aren't really allies
start
anymore.
exactly those kind of
Everyone's
start
looking out for their own ass.
exactly. And you've
Okay.
seen this in the kind of race that we were in the first half of the year, where all of these central banks just seem to be in a race to crush their economy through to seeing who could raise interest rates the fastest.
Do you think we're in a recession, Dario? I mean, when we were exchanging a few ideas on Twitter,
Yeah.
you're talking about the inversion.
No,
Where
I think that we have a kind of fake recession, and even at the start of the year, I was writing about this summer recession scare. And so the fact that it's here and people are panicking about recession, I'm trying not to overreact to that, having been talking about it for 6-7 months. If anything, it's taken longer to materialize than I thought. I thought that, I think this is a kind of fake recession because it's coming from these kind of lingering distortions from COVID. It's coming from the situation in Ukraine. You basically have this kind of bullwhip effect in global manufacturing. And, for decades, economists have built these leading indicators of the global economy based on manufacturing. And the fact is that manufacturing is giving us a really bad steer right now because we're in this kind of bizarro world where everyone was sitting at home buying stuff off the internet, and they weren't going on holiday, they weren't going to restaurants, they weren't going to cafes, they weren't commuting. And we're kind of shifted back to a different world where we've gone back to a kind of pre-COVID normality, and so you've got these massive shifts in spending in the economy, and manufacturing is getting absolutely hammered by that. And of course, all of these manufacturers and retailers and wholesalers were building up these inventories because they thought that this kind of booming economy of 2021 was going to continue indefinitely. So you've had this kind of bullwhip effect in inventories just at the point where demand is flipping the other way. So I think all of that is sort of fake. And I think that we have a massive squeeze on consumers that's coming from just very high levels of inflation, because we're all spending more on energy and food, particularly in Europe, where this is the biggest problem.
Isn't it worrisome that a lot of this spending is showing up in consumer credit, on revolving credit cards? I think that we're extremely high readings, and I know you've seen this movie before. What does that lead to?
I think it's a sign that consumers are just under enormous pressure. And, everyone has been focused on this accumulation of savings during the pandemic, the fact that we weren't doing all those things. We saved all this money. And so there's a lot of liquid assets on balance sheets, but those are very heavily concentrated, among wealthier people. And low income households did not accumulate those kinds of savings, and now they're being hit by these very high prices. So in order to protect their living standard, they're suddenly taking out credit card debt, and that is worrying. And obviously that can't continue indefinitely. But I think I still think a big part of the inflation that we've had is likely to be transitory. I think the inflation is going to come down quite sharply over the next 6 months. And so those pressures will begin to ease. And I think the really important thing, the reason that you don't get a proper recession here is that there are just massive labor shortages, everywhere, but particularly in the US, particularly in the UK, countries that have seen their labor force shrink over the past 2.5 years. And so, because you have those labor shortages, you're not going to see companies firing workers. And that's the bit, if you want to, people can debate.
Then that's going to force a real, what people are already saying is a policy error of backward looking things by the Fed, because if they're focused on the labor market and they want to break the labor market, and it's going to be persistently tough to do, it means they're going to continue to tighten while other conditions are deteriorating.
Well, I think that's right, but I think the recession that we have now is fake. So I'm not too worried about growth. I think housing is the bit we need to watch, because housing is coming from actual demand destruction. The genuine demand destruction this year has come from monetary tightening, and so that's where we're seeing the effects of what central banks have been doing, and that's happening in housing markets. But I think because there are these labor shortages, we're not going to see companies laying off workers, and to me, that's the definition of a recession. A recession is when you get a contraction in employment. That's really the only definition that makes sense. And the reason for that is that when companies start to fire workers, then you get these kind of nasty spillover and feedback loops. That's when consumers then start to cut spending again. That feeds back into the corporate sector because revenues go down, and that leads to more job losses. And so when you're in that kind of dynamic, that's a really nasty feedback loop, and that creates massive uncertainty about how bad the recession is going to be and how long the recession is going to last. And that's the kind of dynamic that investors absolutely hate, because that's just horrible for asset returns. I just don't see that dynamic kicking in. I think if anything, the fact that inflation should come down and wages are now growing quite strong because of this labor shortage, I think we'll actually see real incomes rebound next year. And people will be quite surprised about how quickly the economy recovers. And you can call this a recession or not. If we're debating the technicalities of a recession, then I think that's probably positive at this point, because what a proper recession is when you see it. There's no debate. You don't have to debate whether it's technically a recession or not. And I just don't see those sorts of dynamics kicking in. But the big risk here is obviously central banks, because we've been on this course of very aggressive tightening. If we're raising interest rates 50, 75 basis points every month, then clearly we're going to get to a point where there is, genuine demand destruction, where there is genuine risk of recession. And I think, the inversion in bond markets is really telling central bankers that they need to be careful. People look at inversion and they say, well, inversion tells you that a recession is coming. Well, it sort of does. It sort of tells you that a recession is possible in the next 18 months. But you also get soft landings when the curve is inverted. So what the curve inversion is really doing is it's telling you that the more central banks tighten now, the more they're going to have to cut interest rates next year or the year after. And so it's really telling central banks that they need to be careful. And actually, if you look at the inversions in the past that didn't lead to recession, the reason they didn't lead to recession is because central banks actually responded to what the bond market was saying. So the classic example is 1995, where you had a recession scare. You actually had a contraction in payrolls that was later revised away. So there's a bit of good luck there. But the Fed took notice of that, and it stopped tightening, and it actually eased a little bit. 2019, same dynamic again. I think we basically had a soft landing in 2019 before COVID kicked in. And again, Powell was paying a lot of attention to what the bond market was telling him. Okay. So when you have an inversion and central banks react to that inversion, then that's your best prospect of a soft landing. The problem that we have right now is that the inflation data is not yet allowing central banks, particularly the Fed, the opportunity to actually respond to what the bond market is saying, because they have this kind of nightmare scenario of the 1970s, which is just haunting them. And it's hanging over all of their actions right now.
Okay, so if you're forecasting inflation falling fairly dramatically over the next 6 months, does this make you constructive in the bond market? You want to be long bonds and short things like gold and silver?
I think tactically, I think it means that the kind of terminal rate in yields is likely to come down. I wouldn't say I'm bullish on bonds, because I think that we are moving into a world where inflation is going to be 100 and 150 basis points higher than we've been used to over the 2010s. So I think there is this kind of secular reflation story that is underpinning all of this, and that kind of labor shortage that we have now, I think, is going to turn into a kind of secular theme with things like deglobalization and even demographics to some degree. So I think we're in a secular reflationary environment. I think real returns in bonds over the next 5 years are going to be horrible. I think we're going to get more episodes of transitory inflation where inflation spikes very high. Part of that,
like it did in the 70s, it would abate and then reemerge.
Yeah, I think it's more like the 40s and the 50s. So in the 70s, you had.
Oh, well, I know, but I was, I know a lot of people think I was around in the 40s, but I wasn't yet.
So no, but I mean, I've done a lot of work on the 40s
Okay.
and 50s, and I think it's the close historical parallel, because inflation didn't spiral. So in the 1970s, you had these big, nasty wage price spirals. So you had big spikes in inflation, but then inflation.
The oil embargo.
Yeah, and then inflation settled at a higher level. So you had 3 recessions in the 1970s, and each recession kind of took some of the wind out of inflation, but inflation settled at a higher level after the recession. And so it trended higher during that period, and yields trended higher during that period. And so I don't see inflation trending higher in the same way, but I think it will be persistently higher. And I just think we'll get these periods where it becomes very high and then reverts lower again. And so central banks won't always react to those. So you're going to get more transitory inflation stories. And that means that there'll be this kind of financial repression where, real returns in bonds will get absolutely hammered. And part of that is climate change. So, not just the disruption that comes from climate change itself, but also this transition to intermittent energy sources, which means that we're going to get a lot more volatility in commodity prices than we've been used to for a very long time. And so, I'm not optimistic on bonds. I think that there is a kind of tactical play short term.
What do you like, Dario?
I think so. I talk about the 2020s as the tangible 20s. I think the basic investment world is changing. I think we've had this period of very long perma zero interest rates, endless QE, everything got re-rated. So you didn't have to be particularly sophisticated as an investor. You just put your money into US tech and watched it go to the moon. And I think we're in a world where the basic challenge of policy is changing. So instead of an inflation rate that always threatens to fall below 2%, I think we're in a world where inflation will always be threatening to break above 3%. And so we're not going back to zero interest rates. We're not going to have QE. We're not going to have this continuous re-rating in asset prices. And so what investors want is exposure to the real economy. They need to figure out what are the growth stories for the 2020s, looking beyond all this noise, all of these distortions that we have in the economy right now. I don't think the next 6 months is going to clear up any of these distortions. We're not going to have this kind of head clutching recession that gives this moment of clarity. But I think you need to look beyond that, and you need to think, well, what is the next 5-10 years going to look like? And I think it's commodities. I think it's value stocks. I think it's, materials. It's about, almost a real economic revival, and, actually bringing financial markets and the real economy together again, because they've been completely disconnected over the past 20 years. And I people look at this and they see this kind of very bearish world for investors, but I don't think it's bearish. I think it's just different. And I think there will be investment opportunities in that sort of world, but it's going to be very different to what investors have been used to over the past 15 years.
Is Christopher Granville Joe Granville's son?
I don't think so.
Okay.
He's a former diplomat, so he's a kind of expert on Russia, and there's this YouTube clip about actually getting picked by name by Putin, who answered his question and named him. So he's kind of famous for that. But yeah, I don't think.
Okay.
I don't.
Does he think? I notice Russia, the forever war. Is that the take of the company that you're with?
Yeah, well, it's part of this. It's part of this narrative. So this is a world where something has fundamentally changed over the past 3 years. And a big part of that is the situation in Ukraine. It's the weaponization of the dollar, it's deglobalization, it's the shrinking of global supply chains, it's the reorientation of the world into these kind of trading blocks. It's a very different world. And if globalization brought us kind of endless disinflation, a collapse in worker power, supersized, corporate profits, and low interest rates, then it's the reversal of that. It's a very different type of environment. So it all feeds in to this sort of tangible 20s story that I think is the big theme coming out of all of this chaos of the last couple of years.
Okay, and the relationship after Pelosi's trip to Taiwan? What's T.S. Lombard thinking about that? Is it going to escalate or just simmer?
It's simmering, and it's this is a sort of theme that had started well before COVID, well before Ukraine.
Started with the trade war under President Trump.
The trade war, but it was it's a very popular trade war in the sense that it wasn't just about Trump. It was about U.S. politics, and so this is
it's the only thing that Democrats and Republicans agree on is their hawkishness towards China.
Exactly. That's why
I don't get it.
That's why it seems, almost inevitable at this point. And so it's about that
war seems inevitable.
It's not about hot war. It's more sort of cold war. And it's about a changing in the way that we trade, the kind of untangling of US and China. It's about, strategic economic interests. It's about securing, certain raw materials, securing semiconductors, reducing those interdependencies. It's, it's an unraveling of the kind of neoliberalism of the last 30 years. And to me, that's what the super cycle is, this kind of long 30, 40-year super cycle that we've had in macro, about interest rates, inflation, the economy. It's all been about the balance of power between labor and capital. And, we had, after the 1980s, because of the high inflation of the 1970s, we basically spent 40 years destroying the bargaining power of workers, through tech, through globalization. And that's the thing that's beginning to change. That super cycle is beginning to turn. And I think the implications for investors are absolutely profound. This is a regime change.
How does crypto fit into this new super cycle?
Well, I mean, it in a sense, it doesn't. I think that crypto was kind of the digital tulips, wasn't it, of the last 2 years? And again, I'm a big fan of history. And if you look back at the tulip mania, one of the things that people don't know about that often is that it happened during a pandemic. We had this particularly bad outbreak of the plague. So you had European trade was basically in a sort of lockdown. You had a bunch of merchants that were sitting around in taverns because they had nothing to do. And they'd inherited cash, so they had a lot of excess liquidity from people that died because of the plague, and they were bidding up the price of tulips. And so we've kind of gone through this sort of repeat over the past 2 years with this kind of tulip mania, but happening in the
only they're digital this time.
Yeah, digital. Well, I wrote a note at the peak saying it was called digital tulips, and it was looking at the kind of lesson from history, and I guess as we came out of the pandemic and things went back to normal, and central banks suddenly started to raise interest rates, it killed all of those bubbles. And I guess one of the telling things is that Bitcoin hasn't really come back the way that some of the kind of meme stocks have over the past few weeks. That something has changed here, I think.
Well, maybe the similarity is flowers die.
Yeah.
Even if they're too bid up. So Dario, really was nice connecting up with you and getting your macro feel for what's going on, and sharing that we're in a new paradigm, and it takes people time to adjust to it, and it's early in it, so you have time to adjust. And appreciate you sharing your views. Best way for people to follow your work, would it be on Twitter at your handle, which is your name, at Dario Perkins?
Yeah, so I'm on Twitter. I use Twitter quite a lot. I write a blog, not super often, because obviously we write kind of subscription research, but I write a free blog probably once a month, which is quite popular, so you can find me on there. But Twitter's probably the best place to start.
Okay, so there's Dario's Twitter, and this would be his blogs right here, blogs at TS Lombard, to read his musings of Gordon Brown's guy.
I wouldn't go that far. I would.
I didn't say boyfriend. Okay,
no, I meant
right-hand man for Gordon Brown. Dario Perkins.
I used to run Gordon Brown's global economy forecast in the early 2000s, but then I also worked for his opposition. So I worked for the left and the right, because it was
if I asked Danny Blanchflower about you, what would he say?
Yeah, well, he seems to like me. We
good. All right,
get on quite well. So
all right. Well, I appreciate your giving spirit today, Dario, and
taking
time out of your day to edify our community.
All right, take care.
All right, Dario Perkins, everybody. Good luck the rest of the trading session, and you could join the dream team in 18 minutes on the Morning Edge. Remember, don't just count your narratives, count your blessings, and we'll see everyone tomorrow. Adios, everyone. Have a great day. Win, lose, or draw, you're in the game. Some people can't even get into the game. They have no chips. Protect yours. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.